Okay, guys, next topic is risk and uncertainty. Even though they're used together, there is a slight difference between risk and uncertainty. Risk is used in a situation where the outcome is not going to be certain. Both of them are used in a situation where outcome is not going to be certain. But risk situation is where we have past experience, and with that we can predict it a little bit with accuracy. Not with 100% accuracy, a little bit of accuracy. Risk is faced by mature organizations that have been doing business for many years. They have seen many situations and they can predict things. But uncertainty is a situation where we don't have past experience, we don't know what will happen, we cannot assign probabilities. And uncertainty is faced by new organizations. They haven't been doing business for a while, so they don't know what will happen. So some of the techniques here that we will study are risk techniques, and some techniques are uncertainty techniques. The only technique that relates to uncertainty technique is sensitivity analysis. Every other topic here relates to risk. So let's directly jump onto a question and study those techniques. So this is a question from past paper. Required construct payoff table to show all possible outcomes. Decide the level of cement production the company should choose based on the following decision rules: Maximin, Maximax, expected values. You must justify your decision under each rule, showing all necessary calculations. Describe the Maximin and expected value decision rules, explaining when they might be used and the attitudes of decision makers who might use them. Okay, let's read the question and then I will explain and answer what is required here. Okay, Cementco is a company specializing in manufacturing of cement, a product used in building industry. The company has found that when weather conditions are good, demand for cement increases since more building work is able to take place. Last year, the weather was so good and demand for the cement was so great that cement was unable to meet demand. Cementco is now trying to work out the level of cement production for coming year in order to maximize profits. The company doesn't want to miss out on the opportunity to earn profits by running out of cement again. However, it doesn't want to be left with large quantities of product unsold at the end of the year, since it deteriorates quickly and then has to be disposed of. The company has received the following estimates about the probable weather condition and corresponding demand level for the coming year. Weather condition, if it is good, it has 25% probability, then our demand will be 350. If it is average, 45% probability, demand will be 280. And when it is poor, which has 30% probability, demand is going to be 200. Each bag of cement sells for 9 and costs 4 to make. If cement is unsold at the end of the year, it has to be disposed of at a cost of 0.50 per bag. Cementco has to decide to produce at one of the 3 levels of production to match the forecast demand. It now has to decide which level of cement production to select. Okay, the situation is that this company, Cementco, wants to produce cement, but it doesn't know how much to produce. If it produces too much, what will happen? A lot of it will be left at the end if it is not sold. If it produces little, then if demand is higher, it will not be able to make as much profit as it could if it had to produce more. So it wants to decide in between these three levels, 200, 280 or 350. So using the decision rules we have in the bottom, we will answer that. So the first thing we prepare is payoff table. So these cannot be answered without the payoff table. So let's prepare payoff table. So payoff table shows decisions and their outcomes. So we have 3 decisions here and 3 outcomes. A decision is to make 350 or 280 or 200, and the outcome is that the weather could be good, which means we will be able to sell 350. Weather could be average, which means we will be able to sell 280, or it could be poor, which means we will be able to sell 200. Let's look at the profit or contribution we are going to earn in each of these decisions. Okay, if we decide to produce 350 and demand is 350, how many units we will be able to sell? 350. We will be able to sell whole units. And the contribution per unit, it is said here, they are made they are sold for 9 and cost $4 to make. So it means 9 minus 4, 5 is contribution, and we will be able to earn total contribution of 1750. And remember, units not sold has to be disposed. If we produce 350 and we sell 350, then nothing will be left. It means nothing has to be disposed. And the cost of disposal, they said, is 50 cents. But remember, it also costs $4 to make. So $4 plus 50 cents, which will be $4.5. So there's nothing to dispose, so no cost of disposal. So the net benefit, if we produce 350 and demand is 350, we will earn 1750 net benefits. If we produce 350 and demand is 280, we will only be able to sell 280, multiplying by the contribution. That becomes 1400. And the units that we produce and not sold has to be disposed. So 70 unit has to be disposed, multiplying by the cost will give us 315. So the net benefit would be 1085 if the output is 280. If the output is 200, we will only be able to sell 200, which will give us a contribution of 1000, and the remaining unsold has to be disposed of. So multiplying by the cost becomes 675. So we make a profit of 325. So if we produce 350 units, we could make profits from 325 all the way to 1750. So it has highest and lowest point. The highest point is 1750 and lowest is 325. What if we produce 280 and demand is 350? We will only be able to sell 280 because we cannot sell more than what we have produced. So that becomes 1400. And there will be no disposal because all produced is sold. So 1400 net. What if we produce 280 and demand is 280? Still, we will be able to produce 280, which becomes 1400. And again, there will be no disposal because everything is sold. So the net benefit again is 1400. If we produce 280 and demand is 200, we will only be able to produce 200, which gives us 1000, and we will have to dispose the remaining, which is 80, at 360. So minusing that becomes 640. So we could make from 640 all the way to 1000 profit if we produce 280 units. What if we produce 200 units? Demand is 200. We will be only able to produce 200, and nothing will be disposed because everything will be sold. So the net benefit $1,000. Again, demand 280. We will only be able to produce 280, and nothing will be disposed. So net benefit again 1,000. If demand is 200, we will be able to, if we produce 200, demand is 200, we will only be able to produce sell 200, and again the same situation. So if we produce 200, we can make up to 1,000 profit. Now putting this all of them in a table is called payoff table. So if I write the decisions at the top and write their outcomes here, $280 and 1,000. So decision and outcome. So this is called payoff table. Putting the decisions and the outcomes and the contribution relating to that is payoff table. So one thing is done, construct the payoff table. Next, decide the level of cement production that company should choose based on the following decision. Now, it doesn't give us any decision. It only gives us decisions and their outcomes. It doesn't tell us what to do. The next, remember, these cannot, Maximin and Minimax, cannot be decided if you haven't made the payoff table. So payoff table is made, and after that we will be able to answer those points. Okay. Decide the level of cement production that company should choose based on the following decision rules. Maximin, Maximax, and then there's another one, Minimax Regret. They haven't asked that. I will answer that one as well. And then expected value. Let's look at each of them, what they are. Let's first look at Maximax. Maximax is short for maximum of the maximum. So maximum of the maximum contribution. So we want to see which one has the highest of all highest contribution. And it is taken by, this type of decision is taken by risk seekers. Remember, risk seekers are those people who are interested in highest returns, even if that highest return has low chance. So Maximax, maximum of the maximum return, and it is taken by the risk seekers. So let me bring this down and answer Maximax. Okay, if we look at the maximum output of 350 decision, it is 1750. If we look at the maximum output here, is 1400. If we look at the maximum output here, is 1000. So what is maximum of the maximum? You can see it is 1750. So 1750 is maximum of the maximum. Now this is not a decision. Decision is 350. So risk takers will decide on 350 units to be produced, because 350 will give them highest of the highest return. Next one is Maximin. Maximin is maximum of the minimum. So we believe that the worst outcome will happen. So if worst outcome happens, which outcome has the highest of the worst? So even if the worst outcome happens, in which decision we will be in good place? And it is taken by risk-averse decision makers. Risk-averse decision makers are those decision makers who expect that worst scenario will happen. So if you look at the worst scenario of 350, it is 325. If we look at 280, it is 640. If we look at 200, it is 1000. So the highest of the lowest is 200. So risk-averse decision makers will decide on 200 units because they believe that worst outcome will happen, and they will be happy with 200 when worst outcome happens. Next is expected value. Expected value is when you find average of all the probabilities. Like the outcome of 350, 280, and 200 has 25%, 45%, and 30% probability. Total becomes 100%. Remember, it was given here. So if we find an average of that, it is called expected value. And expected value is taken by risk neutral. Okay. So taking the outcome, multiply by the percentage, all three of them. So the average return of this one is 1023. Let's look at the others. So I'm just taking the outcome, multiplying by probabilities, which will give me an average outcome based on all probabilities. So 1000, and it becomes 1000 because all returns are 1000. So if you find average of it, the result will be 1000. So 1000. So highest of the average. Highest of the average is 1172. So risk neutral will decide on 280 output. Now the disadvantage of expected value that they might ask is it is used for type of decisions that are repeated. They are not used for one-off decision. And the biggest disadvantage is that expected value is not actually going to happen. The outcome is going to be one of these, not an average outcome. So it's not very realistic. And next we have Minimax Regret. So Minimax Regret, it looks at the regret. So we want to minimize the regret. So minimum of the maximum opportunity cost. So regret is opportunity cost. Opportunity cost is when we have chosen one alternative over another. Like here, there are three alternatives. So let's say if I've decided 350 and better outcome is with 280, so I will regret and I will say, I wish I had decided on 280. If I decide on 280 and the best outcome is with 350, then I would wish that I had produced at 350. So we want to see how much is this opportunity cost in each of those decisions. So if outcome is 350, which one will have the highest return? The highest return will be with 1750. If outcome is 350 and we have decided to produce 350, then we will be happy. There will be no opportunity cost here. But if outcome is 350 and we have decided on 280, then we would wish that we produced 350, we would have earned 350 more. Or if we decided on 300, we would wish that we had produced 350, we would have earned 750. If outcome is 280, and which one will have the highest return? This one will have the highest return. There will be no regret. At 350, we will have regret. We will wish that we had decided on 280 because we would have earned 315 more. At 200, we would wish that we had decided on 200 because we would have earned 400 more. What if outcome is 200? Where will we be happy? We'll be happy here. So at 280, we will regret. We will wish that we had made 360 more, and here we will wish that we had made 675 more. So the highest regret here, if we decide on 350, is 675. The highest regret, if we decide on 280, is 360. And the highest regret, if we decide 200, is 750. So what is the minimum of the maximum regret? So if we decide on producing 280, then we would wish the maximum. The maximum contribution that we could lose out of all other options would be 360. And this risk neutral take this decision as well, just like expected values. So yeah, the other requirement was describe maximum expected value and the type of user that they will use. I've already explained that here. Remember, risk seekers are those people, risk seeker or takers, that are interested in high risk, risk averse. They believe that outcome, risk neutral. This is risk neutral, and this is risk averse. Risk neutral are concerned with most likely, which is average, and risk averse believe that the worst possible outcome will happen. Okay? Let's look at another decision tree. It uses the principle of expected value that we just saw, multiplying the outcome by probabilities, but it is used in a more complex situation. So let's look at the question and see what it is all about. So draw a decision tree, include figure for cost, loss, or profit on appropriate branches of the tree. Okay, Beethoven Co. has a new wonder product, the violin, of which it expects the great things. At the moment, the company has 2 courses of action open to it: to test market the product or abandon it. If the company test market it, the cost will be 100,000 and market response could be positive or negative with probabilities of 60% and 40%. If the response is positive, the company could either abandon the product or market it full scale. If it markets the violin full scale, the outcome might be low, medium, or high, and the respective net gains or losses would be 200 loss to 200 profit, and then 1,000 profit in unit of 1,000, which means 200,000, 200,000, and 1 million. The result could range from net loss of 200,000 to a gain of 1 million. These outcomes have a probability of 20%, 50%, and 30% respectively. If the result of test market is negative and the company goes ahead and markets the product, the estimated losses will be 600. If at any point the company abandons the product, there would be a net gain of 50,000 from the sale of scrap. All the financial values have been discounted to present value. Okay, so let's look at the situation. In a decision tree, decisions are represented by squares and outcomes are represented by circles, and they have probabilities and decisions don't have probabilities. So decisions is something we decide, so it is not given any probability, but the outcome is something that happens and they have a probability. So the decision is, let's read the question again. We are launching a product. At the moment it has two courses of action to open to it: to test market the product or abandon it. So we want to decide on two things, either to test market or abandon the product. If the company test markets it, the cost will be 100,000 and the market response could be positive or negative with probabilities of 60% and 40%. So if we test market, which means we will spend about 100,000 on it, then the response could be positive or negative. Remember, this is output. The response is not in our control, and it has a probability of 60% positive and 40% negative, positive or negative. If the response is positive, the company could either abandon the product or market it full scale. So if positive happens, we have another decision. We could either abandon it or market it full scale. If it markets the violin full scale, the outcome might be low, medium, or high. So we could have low, medium, high demand. So this is output. And the respective net gains or losses would be 200 losses all the way to 1 million with probability of 20%, 50%, and 30%. So we have 20% probability, 30%, 50%, and 30%. And we could have a 200 loss here or 200 gain. Remember, they are in thousands or 1,000 gain. So this branch is complete. If the result of the test market is negative and the company goes ahead and markets the product, estimated losses would be 600. If response is negative and then we go full scale, we decide to go full scale, then we would have losses of 600,000. If at any point the company abandons the product, there would be net gain of 50,000 from the sale of scrap. All the financial values have been discounted to present values. At any point, if here we abandon, we will have 50, or if we abandon it here, or if we abandon it here. Anywhere, if we abandon, we can gain 50,000. So, what is the decision we should make? Remember, tree is made left to right, decision is made right to left. So we will start from the furthest branch and see whichever has the highest outcome. So let's look at the outcome of full scale. There are different outcomes with different probabilities, so we will see what is average outcome. The average outcome here is 360, and if we abandon it, it is 50. So which one will you decide with? So you will decide obviously 360. So the decision to test market, if it has a positive result, could mean that we could earn up to 360. So by itself, if we multiply by this probability, it becomes about 216. If the response is negative, which one will you decide? Full scale or abandon? Obviously abandon, because abandon has higher returns. So if we test market and the result is negative, then we will abandon it, which has a probability of 40%. So adding both of these, because their outcome, the average of both of them is 236. If we are spending 100,000 on it, it means we have 136 gain. So test market has 136 gain. We can have up to 136 gain, but abandon has 50. So we would decide on 136. So the decision would be to test market the product. Okay. Let's continue. We have another topic called value for perfect information. So value for perfect information is used in a situation where we could spend money to get information about what will happen in the future. Maybe there are companies who have done research and they know what will happen. So if we want to spend money on information to be collected, what is the maximum amount that we will spend on it? So we have two decisions here. So let's look at it. First, we will look at it without the perfect information, and then we will look at it with perfect information. Okay, so ascertain what decision should be based on expected value if no information was available, and then calculate the value of perfect information. Okay, the management of our must choose between whether to go ahead with either of two mutually exclusive projects. Remember, mutually exclusive means one or the other project can be selected. With project A and B, the expected profits are as follows. From project A, if demand is strong, we would have 4,000 profit, the probability of which is 20%. If it's moderate, then it will be 1,200, probability is 30%. If it is weak, then it will be 1,000 loss, probability of which is 50. And then for option B, the same thing with same probabilities is 1,500, 1,000, and 500. So without the perfect information, so if we wanted to decide, if we look at A, we have 1,200, 4,000, 1,200, and 1,000 loss. If we multiply that by probabilities, 800, and when added together, we have total outcome of 660. 4,000, 1,200, and 1,000. If we look at B, remember the total of all probabilities should be 1, or if it is given as a percentage, it should be 100. So here we have 1,500, 1,000, and 500. So without the perfect information, the B has the highest expected value, so we will choose option B. Now, with perfect information, what if somebody or an organization could give us information of what is going to happen? Then what would we decide on? Let's say they give us information that the demand is going to be strong. So in strong, which one will we choose? We will choose the one that gives us the highest. So it means we will go with A. If they tell us that the demand is going to be moderate, we will still go with A. If they tell us that the demand is going to be weak, then we will go with B. So taking these, multiplying by the percentage probabilities will give us expected value. We have 1410. We minus the return that we can make without the perfect information. So we have value of perfect information 560. What it means is that the maximum we will be willing to pay to get the information should be 560, not more than that. So getting information could mean that we could earn up to 1410 return. Without getting that, we already can make up to 850. So it is 560 extra That is the value of perfect information. But again, it doesn't make sense because all of them are not actual outputs. They are average of the output, and average are never expected to happen. Okay, next we have sensitivity analysis. Sensitivity analysis, remember, is uncertainty technique. So sensitivity analysis doesn't tell us what will happen because we don't know what will happen. We don't have experience. But sensitivity analysis is also called what if analysis. Let me write here what if as well. So in sensitivity analysis, we want to know how much sensitive each variable is. The more sensitive it is, the more there is chance that if they change, we will make loss. We have a question here. Requirement is analyze sensitivity of the project to changes in key variables. So I will find sensitivity of all variables here. Sensitive ITCO has estimated the following sales and profits for a new product which it may launch onto market. We have sales 2,000 units, total cost of which is 4,000, material 2,000, labor 1,000. Sorry, this is selling price, and then cost is 3,000. It gives us 1,000 contribution after minusing the fixed cost from it. It gives you 200 profit. I've copied that information and I've written it here. What I've done is I've converted the information to per unit as well. Sales price and everything I've converted to per unit. Now let's look at the sensitivity of variables. First, let's look at fixed cost. To find sensitivity, you just take the profit and divide it by that variable, like fixed cost here, 800. It will give us sensitivity. Multiplying by 100 will give you percentage, which here is 25%. What it means is that fixed cost is 25%. So what it basically means is that fixed cost profit is 25% of the fixed cost. So if there is 25% change in fixed cost, then more than 25% change in fixed cost, then it would mean we will make a loss. Up to 25%, we will have no profit, no loss. More than 25%, we will make a loss. Let me prove that. You'll not be expected to prove that in exam, but it is good to understand whether it is actually true or not. Okay, so this is our original. Let me change this fixed cost and increase it by 25%. See, there is no profit, no loss. If I change it by more than 25%, then we have loss. So it means that our calculation is, okay, so just take the profit, divide by fixed cost. Do it with every other variable. The only different variable is units. Otherwise, with everything else, you do the same thing. Like with selling price, I will do the same thing. Remember, one is sales units, one is sales price. So here, sales price. So in sales price, you take profit 200 divided by sales, which is 4,000. It becomes 5%. So it means selling price is more sensitive than fixed cost. So if we want to focus, we need to focus on price, that it doesn't, our more focus should be based on price, because it is more sensitive. Only slight changes and it means that we will have no profit, no loss. Let's prove that as well. So if I take the selling price, remember it is revenue, so I need to reduce it. So if it decreases by 5%, it becomes 95%, no profit, no loss. If I decrease it by more than 5%, then we have loss. So it proves. Next, material, we will do the same thing. Taking the cost of material, which is 2,000 here. Profit divided by cost of material 2000, so it should give us sensitivity, which is 10%. Less sensitive than sales, but more sensitive than fixed cost. Let's prove that as well. So let's increase this by 10%. No profit, no loss. If I increase it by more than 10%, then we will have loss. This is being rounded off, okay? Next, labor, we do the same thing. Profit divided by labor. Labor is 1000. So profit divided by labor. %, less sensitive than material. Let's prove it. So no profit, no loss. Let me no profit, no loss. If it increases by more than that, then there will be loss. Okay, next, finally, units. For units, you can do this. So only remember that for sales units, you have to find break-even point. Everything else is just profit divided by whichever variable you want to find sensitivity for. So for sales units, you have to find break-even point, which is fixed cost divided by contribution per unit. Contribution per unit is $2 minus 1.5, which is 0.50. You could take 1000 divided by 2000. It will also give you the same answer. So 1000 divided by 2000 contribution, so it should give us break-even point of 1600. So we have to find margin of safety. Remember, margin of safety is how much safer we are from making loss. So our budgeted units are 2000, break-even unit are 1600, so we have 400 margin of safety. If we look at it as a percentage, it is 20%. So sensitivity of units is 20%. Let's prove that as well. So if I decrease units by 20%, so I have to decrease the cost as well. So we have no profit, no loss. So if we look at the sensitivities, the more sensitive is sales price. And then after that comes material, and then labor and units. They have same percentage. And then finally, simulation model. A simulation model doesn't have an exact answer, so I will not expect it to come in exam. I would expect it to come as a theoretical rather than practical question. So let's look at a question and then I will explain what is happening. So it uses the principle of expected values. A supermarket sells a product for which the daily demand varies An analysis of daily demand over a period of about a year shows the following probabilities. So we have demand and their probabilities. 35 demand has 10% chances, then 20%, 25%, 38%, and so on. The total of all should be 1 or 100% probabilities. So what you do is you take the numbers and their probabilities. Based on those probabilities, you give them numbers. You start from 0. Like this has 10 probabilities. You give them 10 numbers, which becomes 0 from 0 to 9. And then this other one has 20% probability. You give them number after that, becomes 10, up to 29 becomes 20 numbers. And then this has 25% probability, and so on. So it will become 99. So because we are starting from 0, it will become 99. We don't want it to go to third digit. We want it to remain in 2 digits. So what then computer does is, computer generates random numbers, and based on that random numbers, you will know what will happen. Like what I did, I asked some students in the class to give me random numbers, and these are the numbers that they give me. So from 0 to 100, any random numbers. So I received 63 number, 74 number, 23, 85, 47, 60, 18, 26, 99, 11, 70, and 2. These are the random numbers the student gave me. So I saw these numbers, and I saw in the table here, and I found which units they relate to. Like 63 relates to this one, so 38 units. 74 also relates to the same thing. 23 relates to this one, 36. So I found the units for all of them, and then what I did, I added all of them. Remember, you can take as many numbers as possible. The more numbers you take, the more accurate it is going to be. So I'm going to take total and divide by total number of data that I've taken. It will give me an average. So this is the expected outcome that will happen. And if you see here in the question, the highest probability is with 38, which is 30%, and with 37, which is 25%. If you look at this number, it comes in between both 37 and 38%, even though they were random numbers, but because they have high probability, they have high chances of being selected, the number that is found is very closer to that. So this completes sensitivity analysis.